Welcome back to the deep dive. We're plunging into a topic that feels fundamental to finance, yet, can seem like a real maze, the world of stocks.
And today we're drawing specifically from the insights of an introductory guide to understanding stocks. The idea is to give you a really solid foundation in this, well, let's face it, complex marketplace.
Right. Our mission for this deep dive is pretty clear. We want to cut through the jargon, really get what owning a stock means, how the whole market machine actually works.
And explore the different ways people try to make money from it, definitely.
Yeah, and importantly, shine a light on the risks, the analysis methods people use, and maybe those common traps that catch people out. The goal is to help you feel, more confident and informed when you hear about the stock market.
And hopefully we'll dig up some genuinely surprising bits along the way. Maybe something about its super old school origins, or perhaps that one common mistake that trips up even experienced investors sometimes.
All right, let's jump right in then. At the most basic level, what is a share of stock? Really?
Think of it this way. When you buy a share of stock, you are buying a tiny piece of ownership in a corporation. That's pretty much it.
Okay.
You'll hear them called stocks, sure, but sometimes equities or securities, they all basically mean a piece of the ownership pie.
So owning a share makes you an investor or shareholder, and technically that gives you a vote in company stuff.
That's the formal definition, yes. As a part owner, you get one vote per share you own.
Right.
But realistically, unless you're a huge institution owning millions of shares, your individual vote is, well, it's tiny. Your ability to actually influence the company, minimal, let's say.
Got it. Okay, so why would a big company, decide to issue these little ownership pieces in the first place?
The main reason. To raise money. Simple as that. They sell shares to the public to attract capital, money they can use to grow the business, fund new projects, expand. It's a way to get investment from lots of people.
And on the flip side, why do we buy them? What's in it for the investor?
Well, the primary driver is the hope, right? The hope of selling it later for a higher price. That profit you make, selling for more than you paid. That's called a capital gain.
And if it goes down?
That's a capital loss, if you sell for less than you paid.
And is it, guaranteed to go up just because you bought it?
Oh, absolutely not. And this is so crucial to get right from the start. The price can absolutely go down. Even for companies that seem really strong, really profitable, there's no guarantee of making a profit. None.
The guide mentions these old school stock certificates. Are those still a thing?
They are, technically.
Yeah.
A stock certificate is the physical paper proof of your ownership. Some people still like having them, maybe frame them. But for practical trading today, your brokerage firm usually holds that ownership info electronically. It just makes buying and selling way faster.
And the material mentioned two kinds of stock, common and preferred.
Right. But honestly, for almost all individual investors, you're dealing with common stock. That's the standard kind. Preferred is a bit different, less common for individuals. And remember, only corporations issue stock. Not every company out there does.
And we're talking about names we recognize here, right? Companies whose stock you might actually think about buying.
Exactly. The guide lists examples like Microsoft, IBM, Disney, General Motors, GE, McDonald's, those big publicly traded corporations. That's the arena we're talking about.
So the simple goal is making money, usually by selling higher. But where does all this buying and selling actually happen? Where's the venue?
That happens on stock exchanges.
Okay.
And the history is actually pretty fascinating. It goes way back to 1792 in New York.
Wow, okay.
You had these 24 brokers and merchants trading securities basically outdoors under a buttonwood tree on Wall Street.
Wow.
Wild, right? They decided to formalize things, agreed to trade shares only among themselves, set a commission.
That sounds like the beginning of the New York Stock Exchange.
That's exactly it. The Buttonwood Agreement, that was the seed that grew into the NYSE. So a stock exchange is essentially an organized marketplace. Historically a physical place, but now mostly electronic. It's where buyers and sellers meet to trade shares.
And Wall Street, that actual street, just became shorthand for the whole financial system.
It did. Wall Street is now symbolic of the whole complex of U.S. stock exchanges and the big financial institutions clustered there. Today, the U.S. has three main major stock exchanges.
Okay, what are they?
First, the NYSE, the New York Stock Exchange, like we said, grew from those early traders, still lists many of the biggest, most established blue-chip companies. Think Walmart, Coca-Cola, Johnson & Johnson.
Right.
Then there's the ANX, the American Stock Exchange. It also grew out of curbside trading, kind of the traders who weren't part of the original NYSE group.
And the NASDAQ. That one feels more modern.
It is much more recent. NASDAQ started in 1971. made history as the first electronic stock exchange. No physical trading floor, just a huge computer network. It's known for listing a lot of tech companies, Cisco, Intel, that kind of thing. And it's also where many smaller, over-the-counter, or OTC stocks trade.
How many stocks are we talking about across these exchanges? Thousands.
Oh yeah, thousands. Over 5,000 stocks trade on just those three major U.S. exchanges. Plus maybe another 5,000 smaller companies trade OTC. The guide also mentions other U.S. exchanges, like Philadelphia, which is actually the oldest organized exchange in the U.S., and of course tons of international exchanges globally. London, Tokyo, Frankfurt.
And the fact that these exchanges compete with each other, that's actually good for someone like me wanting to trade.
Absolutely. That competition forces them to be more efficient. They need to execute your buy and sell orders faster, cheaper, because they're all fighting for your business. It definitely benefits investors.
So we know what a stock is, where they're traded, who are the actual people doing all this trading. It's not just individuals, right?
No, definitely not just individuals like us. The guide breaks it down into roughly two main groups: investors and short-term traders.
Okay.
Investors are generally focused on the long haul, the company's prospects. They buy shares, planning to hold them for months, maybe years, looking for the company's value to grow over time.
Like those examples in the guide, people who bought Caterpillar or Lockheed Martin back in the 90s and saw big gains.
Exactly. That was a period where holding good companies long-term often paid off really well. Share prices doubling, tripling.
And short-term traders, they're playing a different game.
Completely different. Their focus is purely on profiting from short-term price swings. They might not care much about the company's actual business or its 5-year plan. They just want to buy low, sell high, quick turnaround, minutes, hours, days, weeks, maybe.
And the most intense version of that is the day trader.
Right. A day trader is really aggressive. They make multiple trades within a single day, often aiming to be totally out of the market, back in cash by the time the closing bell rings, trying to scalp tiny profits from small price moves.
Sounds stressful.
It is. Requires intense focus, discipline. And the guide makes a point of saying it's incredibly difficult to make money consistently doing it. Very few actually make a living that way.
And then beyond individuals, there are the huge players, the professional traders.
Yep, these are the institutional investors. They work for the big firms, Wall Street brokerages, the exchanges themselves, massive pension funds, banks, mutual fund companies. They're trading enormous sums of money, often billions, either for clients or for their own firm's account.
And their actions can really move the needle, right? Affect prices.
Absolutely. Institutional investors wield huge influence. When they decide to buy or sell a massive block of shares in a company, that alone can significantly move the stock's price. They can even shift the direction of the whole market sometimes. Some even use super sophisticated computer programs to trade automatically based on certain price conditions.
Okay, so with all this activity, how does the market keep track of price changes? It's not just simple dollars and cents, is it? I hear about points.
Right. Wall Street uses a system based on points, where 1 point usually represents $1. So if a stock moves from, say, $5 a share up to $10 a share, that's called a 5-point gain.
And that's how you figure out your profit or loss.
Exactly. It's the point change multiplied by the number of shares you own. So if you have 1,000 shares and the stock goes up 1 point, you've made $1,000. If it goes up 2 points, that's $2,000 on those same shares. The more shares, the bigger the impact of each point move, up or down.
And to measure the overall market's health or direction, we use indexes.
Yes, precisely. That's where market indexes come in. The most famous is probably the Dow Jones Industrial Average, the Dow. Started by Charles Dow way back late 1800s. Initially tracked railroads, then industrial companies.
Doesn't it only track a few companies now?
It does. Only 30 large companies today. But watching the Dow gives you a quick general sense of the market's trend. Is it moving up, down, sideways? Other really key indexes are the NASDAQ Composite, which tracks mostly tech and NASDAQ-listed stocks, and the S&P 500, which is much broader, covering 500 large U.S. companies. And these indexes themselves also use the point system to show their daily change.
So given there are millions of people wanting to buy and sell at any moment, how does the exchange actually make sure that if I want to buy, say, 100 shares of IBM, there's someone ready to sell it to me right then? How does that matching work?
That's a great question, because without that constant matching, that liquidity, the market would just grind to a halt. The exchanges have systems, intermediaries, to ensure there's always someone on the other side of your trade.
Yeah.
Maybe not at the perfect price you dreamed of, but you can almost always make the trade.
And that's where roles like specialists or market makers come in?
Exactly. On the NYSE, you traditionally have specialists. Each specialist is assigned specific stocks. Their job is to maintain a fair and orderly market in those stocks. They actually use their own capital, their own money, to step in and buy or sell if there's an imbalance between buyers and sellers. They make money on the tiny difference between the buy and sell price, the spread, and sometimes commissions.
And on the NASDAQ, it's different because it's electronic.
Right. On the electronic NASDAQ, instead of a single specialist, you have multiple market makers for each stock. These are firms that compete to post the best buy and sell prices, matching orders electronically. More popular stocks, like Microsoft, might have dozens of market makers competing, which helps keep the spread tight.
So all this matching is happening lightning fast behind the scenes now.
Totally. Billions of shares change hands daily. Computer systems route your order, find the best available price across different market makers or even other exchanges, and execute the trade, usually within seconds.
And ECNs are part of that electronic plumbing?
Yep. ECNs, or electronic communication networks, are basically private computer networks that also match buy and sell orders electronically. They work alongside the main exchanges. They were a big factor in increasing speed, efficiency, and driving down trading costs, those commissions, for investors. Your order often gets routed through an ECN to find the best match.
Okay, so for someone who isn't like a hyperactive day trader, do I really need to know the difference between a specialist and a market maker and an ECN?
Probably not the intricate details. The guide suggests that for most long-term investors, the key thing is just knowing that the system works. It ensures your orders get sold quickly and at a fair, reasonable price. While some active traders use special software, level 2 quotes, to see all the different bids and offers and try to squeeze out an extra penny, for most people, just getting efficient execution is what matters.
All right, let's shift to reading the market. When you look up a stock online or in an app, you get this table of numbers, a stock quote. What are the absolute must-know pieces of information there?
Right. That snapshot is the stock quote or quotation. It gives you the vital signs at that specific moment. The absolute most fundamental parts are the bid price and the ask price.
What is the difference between bid and ask?
The bid is the highest price anyone in the market is currently willing to pay to buy the stock. So if you want to sell your shares right now, the bid is likely the price you'll get. The ask, or offer, is the lowest price anyone is currently willing to accept to sell the stock. So if you want to buy shares right now, the ask is likely the price you'll have to pay.
And the gap between those two is the spread.
Exactly. The spread is simply the difference between the current bid and ask prices. It's basically a transaction cost, part of how the market makers or specialists earn their keep. Years ago, when stocks traded in fractions like eighths and sixteenths, spreads could be much wider. Now, with decimal pricing, they're often just pennies for actively traded stocks.
What other numbers in a typical quote are important?
You'll definitely see the previous close, the price the stock finished at the end of the last trading day. Then the change, which shows how much the price has moved today, both in dollar amount and as a percentage. Very important is volume. That tells you how many shares have actually been traded so far today. High volume usually indicates strong interest or conviction behind a price move.
Then the 52-week range.
Right, the 52-week high and low. That shows you the highest and lowest prices the stock has traded at over the past year, giving you a sense of its volatility in recent extremes. You'll also often find other info, like the company's total value or market cap, the number of outstanding shares, and whether or not it pays a dividend.
That's a lot of data, but the guide makes a really crucial point here. The stock's price itself doesn't tell you if it's a good deal.
This is such a key insight. You absolutely cannot look at a low stock price, say $5 a share, and automatically think, oh, that's cheap, it must be a bargain. That $5 stock might belong to a company drowning in debt with terrible prospects. Meanwhile, a stock trading at $50 might actually be a fantastic value if the company is highly profitable, growing fast, and well managed. Price is just one piece of the puzzle.
It reminds me of that Warren Buffett idea of buying a wonderful company at a fair price, not necessarily a cheap one.
Exactly. It's about value, not just the price tag. That's why analysts use tools like the price-earnings ratio, or PE ratio, which we can talk more about. It helps you gauge the price relative to the company's actual earnings, giving you a much better sense of whether it's reasonably valued or maybe overpriced.
Okay, so let's say you've done some research, you understand the quote, and you've decided you actually want to buy some stock.
Oh.
How do you physically or electronically do that? Where do you start?
Right. The main way most people buy stocks is through a brokerage firm. You open an account with them, and generally you encounter two main types of firms: full-service firms and discount firms.
What's the deal with full-service firms?
Traditionally, a full-service firm assigns you a specific person. They may be called a financial advisor, a consultant, an account executive, used to be just stockbroker. This person gives you advice, recommendations, helps manage your portfolio, and places your buy and sell orders for you.
How do they get paid? Is it commissions?
Historically, yes, often through commissions charged on every single trade you make. The guide points out a potential conflict of interest there, right? The more you trade, the more commission they earn, which could theoretically incentivize them to encourage excessive trading, known as churning, which is illegal, by the way.
So that relationship needs trust.
Absolutely. Some firms now are moving towards charging an annual fee based on the total value of your account, which might align interests better. But yeah, if you go the full service route, finding an honest, competent advisor you trust is absolutely critical.
And the other type, discount firms.
Discount firms, as the name suggests, offer much lower commissions. They're often online platforms or mobile apps. They cater more to the do-it-yourself investor, someone who prefers to do their own research, make their own decisions, and just needs a platform to execute trades cheaply and efficiently. They typically don't offer personalized advice.
So you pick a firm, open an account. What's involved there?
Usually involves providing basic personal information, name, address, social security number, maybe some financial suitability questions, and then funding the account with money, usually by linking a bank account or sending a check. Once it's funded, you're ready to place orders.
The guide mentioned different ways to place an order, like a market order.
A market order is the simplest and quickest. You basically tell your broker, buy me X shares of this stock right now at whatever the best current market price is, or sell my shares right now at the best current price. It guarantees your order gets filled almost instantly, but you don't have control over the exact price. The guide kind of compares it to walking into a car dealership and just saying, I'll take it. Without negotiating, you might not get the absolute best deal.
Okay, so what's the alternative? A limit order.
Exactly. A limit order gives you price control. When buying, you set a maximum price you're willing to pay per share. The order will only execute if the stock price drops to your limit price or lower. When selling, you set a minimum price you're willing to accept. The order only executes if the stock price rises to your limit price or higher. It lets you try and get a better price than the current market quote.
But the catch is, your order might not get filled at all.
That's the trade-off. If the stock price never reaches your specified limit price during the time your order is active, it simply won't execute. Your order might sit there unfilled.
And you can decide how long the order stays active.
Yes. Typically, you can choose between a day order, which automatically expires at the end of the current trading day if it hasn't been filled, or a good till canceled GTC order, which remains active day after day until it's either filled or you manually cancel it.
Any wisdom from the guide on when to place orders, like times to avoid?
Yeah, it generally suggests it might be wise to avoid placing orders, especially market orders, right at the market open, say the first 30 minutes and right before the market closed the last 30 minutes. These times tend to be more volatile, with prices jumping around more and potentially wider spreads between the bid and ask.
Okay, let's tackle something that sounds inherently, well, dangerous. Using leverage or going on margin. What is that?
Yes, margin. This is basically borrowing money from your brokerage firm to buy more stock than you could afford with just your own cash. The brokerage lends you money, often at a rate like 2-to-1, meaning for every dollar of your own money you put up, they'll lend you another dollar. And of course, you pay interest on that borrowed money.
The appeal must be amplifying your potential gains, right?
That's exactly the hook. If the stock you bought using margin goes up, your percentage return on your own invested capital is magnified because you controlled more shares. You've leveraged your position to potentially make more money faster.
But the flip side sounds scary, like you could lose more than you put in.
That is absolutely the terrifying downside. The risk is significantly amplified too. If the stock you bought on margin goes down, your losses are also magnified. Because you borrowed money, you can lose not only your entire initial investment, but potentially owe the brokerage even more. Stocks can fall much faster than they rise, and margin makes those losses happen much bigger, much quicker.
And this has played a role in historical market crashes.
Definitely. The guide points out that in the 1920s, margin requirements were very low. People could borrow a lot relative to their own cash. This widespread leverage was a major contributing factor to the severity of the 1929 market crash. When prices started falling, margin buyers got wiped out, leading to forced selling, which pushed prices down further. A vicious cycle. The SEC, which was created after the crash, put much stricter margin rules in place.
And the term margin call, it doesn't sound friendly.
It is not friendly. A margin call is when the value of the stocks in your margin account falls below a certain level required by the brokerage, called the maintenance margin. The brokerage then calls you, or send an alert, demanding that you deposit more cash or sell securities immediately to bring your account equity back up to the required level.
What if you can't come up with the money?
If you can't meet the margin call quickly enough, the brokerage has the right to liquidate, sell your stocks, without your permission, often at the worst possible prices, to cover the loan they gave you. The guide notes that thousands of people lost huge amounts of money this way during the bear market that preceded the guide's writing.
So the author's bottom line on using margin.
It's very, very strong advice. Just don't do it. Avoid margin unless you are a highly experienced, highly disciplined professional trader who fully understands and can manage the immense risks. Don't gamble with borrowed money. Only invest what you can truly afford to lose without putting your financial life in jeopardy. Getting a margin call is a brutal lesson.
Beyond just the price going up or down, are there other kinds of risks we face when we're involved in the market?
Oh, absolutely. Price volatility is the most obvious risk, but it's not the only one. There's always the fundamental risk of losing some or even all of the money you invest in any particular stock or fund. And as we just talked about with margin, or short selling, which we might get to, it's even possible to lose more than your initial investment.
What are some of the other specific types of risk the guide mentions?
Well, there's market risk. This is the risk that the entire stock market declines, pulling most stocks down with it, often due to big external events like a recession, a war, a global pandemic, or even acts of terrorism. Nothing your specific company did wrong. The whole tide just went out.
Okay.
Then there's individual stock risk, or company-specific risk. This is the risk that the particular stock you own does poorly or goes down, even if the overall market is doing fine or even going up. Maybe the company has bad management, loses a key contract, faces new competition. Lots of reasons.
And interestingly, the guide says that there are risks even if you don't invest.
Yes, this is crucial. There's inflation risk. If you just keep your money stuffed under the mattress or even in a very low-interest savings account, inflation, the general increase in prices over time, meaning your money buys less, will slowly but surely erode the value of your savings. That $100 today won't buy as much in 10 years.
And opportunity risk.
Opportunity risk, or opportunity cost. That's the risk of missing out on potential gains you could have made if your money had been invested in growing elsewhere, rather than sitting idle or earning very little.
So the takeaway isn't really about avoiding risk altogether because you can't.
Exactly. Risk is everywhere, whether you invest or not. The goal is to understand the different types of risk, figure out which ones you're comfortable taking, and then use strategies to manage those risks effectively based on your own financial situation, timeline, and goals.
Okay, let's broaden the horizon a bit beyond just individual stocks. The guide talks about other types of investments people use, starting with bonds. What exactly is a bond?
Right. If stocks represent ownership, bonds represent debt. When you buy a bond, you are essentially lending money to the issuer, which could be a corporation or a government entity, like the U.S. Treasury or your local city.
And they promise to pay you back, with interest.
That's the deal. In bond speak, the issuer promises to pay you a fixed amount of interest, called the coupon, usually paid semi-annually, for a set period of time.
Right.
At the end of that period, on the maturity date, they promise to return the original amount you lent them, which is called the principal or face value.
Are there different kinds of bonds, like safer or riskier ones?
Yes, several types. Treasuries bonds issued by the U.S. federal government are generally considered the safest bonds in the world because they're backed by the full faith and credit of the U.S. government. Munis, or municipal bonds, are issued by state and local governments. Their main attraction is that the interest income is often exempt from federal income tax, and sometimes state and local taxes too. Corporate bonds are issued by companies. They generally carry more risk than government bonds because companies can go bankrupt, but they typically offer higher interest rates to compensate investors for that extra risk.
And they come in different lengths of time, like stocks don't really have an end date.
Exactly. Bonds are categorized by their maturity. Bills, or T-bills, mature in 1 year or less. Notes typically mature in 1 to 10 years, and bonds mature in more than 10 years, sometimes as long as 30 years. Generally speaking, the longer the time until maturity, the higher the interest rate or yield the bond will offer because your money is locked up for longer and exposed to risk for longer.
The guide gives an example, like a $5,000 bond paying 10% for 10 years.
Right. That means you get $500 in interest payments each year $5,000 and 10% for 10 years, and then at the end of the 10 years, you get your original $5,000 principal back.
What's the main worry with bonds? What's the risk?
The biggest risk is default. Risk the chance that the issuer, the corporation, or maybe even a government entity, fails to make its promised interest payments, or can't repay the principal when it's due because they've gone bankrupt or run into severe financial trouble. The guide specifically mentions bondholders of companies like Enron and WorldCom who lost their investments when those companies collapsed. So, while often seen as safer than stocks, bonds are definitely not risk-free. People who really dislike stock market volatility often prefer bonds, though.
Okay, next up are mutual funds. These seem incredibly common. What are they?
Mutual funds are basically investment companies that pool money together from thousands, maybe millions, of individual investors. Then, a professional fund manager takes that big pool of money and invests it in a diversified portfolio of securities that could be stocks, bonds, sometimes other things, or a mix.
And why are they so popular? What's the main appeal?
The number one reason, overwhelmingly, is diversification. Remember that don't put all your eggs in one basket idea. Mutual funds are the easiest way to achieve that. Instead of you needing enough money to buy shares in, say, 50 or 100 different companies yourself to spread your risk, you can buy shares in one mutual fund and instantly own a tiny slice of potentially hundreds of different stocks or bonds.
The guide used that WorldCom example, right?
Yeah, it's a powerful illustration. If all your money was in WorldCom stock when it collapsed, you lost pretty much everything. But if WorldCom was just one small holding out of 200 stocks in a diversified mutual fund you owned, the impact on your total investment would have been far, far smaller. Maybe a bad day cost you 3% instead of 90% or 100%. That's the power of diversification.
Makes sense. Are there other advantages?
Ease of use is a big one. You can often invest relatively small amounts, even set up automatic monthly investments. Tracking the fund's performance is usually easy. They're listed in financial news, online, and it's often simple to switch your money between different funds offered by the same fund company if your goals change. Plus, there's a mutual fund for almost any imaginable investment strategy or sector you might be interested in: tech funds, international funds, bond funds, funds focused on small companies, large companies. You name it.
I've heard about no-load versus load funds. What's that about?
That refers to sales charges or commissions. A load fund charges you a fee either when you buy shares, front-end load, or sometimes when you sell, back-end load. A no-load fund does not charge these sales commissions. The guide strongly suggests sticking with no-load funds. Why? Because there's absolutely no evidence that paying load results in better investment performance. It just means less of your money actually gets invested. Go no-load if you can.
And index funds are a specific type of mutual fund?
Yes, they are a very popular type, especially now. An index fund doesn't have an active manager trying to pick winning stocks or time the market. Instead, its goal is simply to replicate the performance of a specific market index, like the S&P 500. It buys all the stocks in that index in the same proportion as the index itself.
Why have they become so popular?
Primarily because they are very low cost. Since there's no highly paid active manager and less trading involved, their annual expenses are typically much lower than actively managed funds. Also, as the guide points out, studies consistently show that a majority of active fund managers actually fail to beat their benchmark index over the long term. So for many investors, just accepting the market's average return through a cheap index fund is a very sensible and often more successful strategy.
The guide does mention, though, that while funds did well in the 90s, many struggled more recently relative to when it was written. What's the takeaway there?
It's just a reminder that nothing goes up forever, and past performance is no guarantee of future results. Even professional managers can hit rough patches, and market conditions change. It just highlights the need to choose your funds carefully, understand their strategy and the risks involved, and not just chase past winners blindly.
Okay, what about real estate as an investment category?
Well, buying a home is often the biggest investment most people make, and it can be a very smart one. Over time, home ownership can help build wealth, and there are often tax advantages, like deducting mortgage interest. Plus, for many, it feels better than renting long-term, and can sometimes be cheaper over the very long run.
What are the downsides compared to, say, stocks or funds?
The biggest difference is liquidity. Real estate is generally very illiquid. You can't just sell your house instantly if you need cash quickly. It takes time, effort, and transaction costs. Plus, you have ongoing expenses: mortgage payments, property taxes, insurance, maintenance, repairs. Renting is simpler and offers more flexibility if you need to move frequently.
And REITs are a way to invest in real estate without actually owning property.
Exactly. REITs, which stands for Real Estate Investment Trusts, are companies that own, operate, or finance income-producing real estate things. Things like shopping malls, apartment buildings, office towers, warehouses, hotels. You buy shares in a REIT on the stock exchange, just like buying shares of any other company.
What's the advantage of REITs over buying property directly?
The main advantage is liquidity. You can buy and sell shares of a REIT easily and quickly, just like a stock. It gives you exposure to the potential return and diversification benefits of real estate investing without the hassle of being a landlord, managing properties, or needing a huge amount of capital up front.
What's the risk with a REIT then?
The risk is similar to owning any stock. The value of the REIT shares can go down if the underlying real estate market performs poorly, or if the REIT's management makes bad investment decisions, or if the company takes on too much debt. You're relying on the REIT's managers to run the business well.
Let's circle back to stocks specifically and talk about how they're classified. The guide mentions classifying by size using market capitalization.
Right. Market capitalization, or just market cap, is a fancy term for the total value of a company's stock in the market. You calculate it really simply. Multiply the company's current stock price per share by the total number of outstanding shares it has issued.
So a $50 stock with 10 billion shares
Would have a market cap of $500 billion.
Exactly.
Yeah. Market cap changes constantly as the stock price fluctuates. It's the standard way analysts and investors categorize companies by size. You hear terms like large cap, mid cap, small cap. Large corporations have high market cap, smaller companies have lower ones.
You mentioned outstanding shares. The guide also talks about the float. What's the difference?
Outstanding shares is the total number of shares a corporation has issued that are currently held by all shareholders. This includes shares held by the public, by company insiders like executives and directors, and sometimes large institutions that hold shares long-term. You find this number in financial reports. The float is a more specific number. It represents only the shares that are actually available for trading by the general public on the open market. It excludes those closely held shares owned by insiders or controlling institutions that aren't likely to be traded frequently. The float is the pool of shares that really drives the daily supply and demand dynamics.
Okay, stocks are also classified by their investment style or strategy. Can you break down value stocks versus growth stocks?
Sure. Value stocks are typically shares of companies that are considered to be trading at a price below their true underlying worth, or intrinsic value. These companies are often profitable, maybe in more established or mature industries, but perhaps they're temporarily out of favor with the market. Value investors use fundamental analysis, digging into the financials, looking for metrics like low price earnings ratios, low price to book ratios, trying to find these bargains. It often requires patience, waiting for the market to eventually recognize the company's true value.
And growth stocks are the opposite end of the spectrum.
Pretty much. Growth stocks are shares of companies whose sales or earnings are growing at a much faster rate than the overall market or their industry peers. These are often companies in newer, rapidly expanding sectors, like technology or biotech. Investing in growth stocks offers the potential for tremendous returns if that rapid growth continues, but they also tend to be riskier and often trade at higher valuations, higher PE ratios, because investors are paying a premium for that expected future growth. They were very popular in the 90s tech boom.
And there's a hybrid approach called GYARP.
Yes. GYARP stands for growth at a reasonable price. It's a strategy that tries to blend the two. GYARP investors look for companies with strong growth potential, but they're also mindful of valuation. They try to avoid paying excessively high prices, looking for growth stocks whose prices haven't gotten totally out of hand yet, growth, but at a fair price.
What about income stocks?
Income stocks are primarily bought for the dividends they pay out. These are often shares of large, stable, mature companies, often blue chips, that generate consistent profits and distribute a portion of those profits directly to shareholders as regular cash payments, dividends. They're particularly attractive to investors who need a steady income stream from their portfolio, like retirees. Although the guide notes that during the 90s, many companies cut back on dividends to reinvest profits, and tech companies historically didn't pay them much.
And the company's board decides on dividends.
Yes, the board of directors decides if the company will pay a dividend, how much it will be, and how often, usually quarterly. The guide gives an example. If a stock pays a $1.25 dividend per share each quarter, and you own 5,000 shares, that's $1 per share per year, giving you $5,000 in annual dividend income.
Lastly in this category, penny stocks. What defines them and why the caution?
Penny stocks are generally defined as stocks that trade at very low prices, typically under $5 per share and sometimes literally for pennies. The supposed appeal is that because the price is so low, you can buy a huge number of shares with very little money. So even a small price increase, like from 10 cents to 20 cents, represents a 100% gain. Huge percentage potential.
But the guide sounds very wary of them.
Extremely wary. And for good reason. Stocks are often penny stocks because the underlying company is struggling. Maybe it has poor management, no earnings, lots of debt, or an unproven product. They also tend to have very low trading volume, meaning not many shares trade each day. This makes them illiquid, hard to buy or sell without significantly moving the price yourself. And crucially, this low volume and lack of information makes them highly susceptible to manipulation.
Manipulation like scams.
Exactly. They are prime targets for pump and dump schemes, which we could definitely talk more about later. Because it takes relatively little money to influence the price, scammers can easily inflate the price artificially and then dump their shares on unsuspecting buyers. Bottom line, penny stocks are extremely risky, more like gambling than investing for most people.
Okay, let's talk about some specific strategies or tactics people use, sometimes called the fun things to do in the guide, though maybe strategic things is better. We've hit on this first one multiple times, but it bears repeating. Diversification.
Absolutely. Can't stress it enough. Diversification is the bedrock of managing risk. It means spreading your investment money across many different types of securities. Not just different stocks, but stocks in different industries. Tech, healthcare, consumer goods, etc. Different company sizes, large, small, different styles, growth, value, maybe different countries, international stocks, and even different asset classes altogether, like including bonds or maybe some cash in your portfolio. The whole point is to avoid having all your hopes pinned on just one or two investments going right.
Because if one goes bad,
It doesn't sink your entire ship. If you were heavily invested in just Enron, you were devastated. If Enron was just 1% of a well-diversified portfolio, it was painful, sure, but not catastrophic. The challenge, as the guide notes, is that achieving proper diversification with individual stocks might require owning 25, 30, maybe even 50 different stocks across various categories, which takes significant capital.
which is why mutual funds are often recommended for this.
Yes, exactly. For most individual investors, especially those starting out or with less capital, buying a broadly diversified mutual fund, particularly a low-cost index fund that holds hundreds of thousands of stocks, is the most practical and effective way to achieve good diversification right off the bat.
Okay, next tactic. The stock split. This sounds good, like you get more shares for free.
You do get more shares, but the total value doesn't change. Here's how it works. In a typical 2-for-1 stock split, the company doubles the number of shares each shareholder owns, but simultaneously cuts the price per share in half. So if you owned 100 shares trading at $80 per share, total value $8,000, after a 2-for-1 split, you'd own 200 shares, but they'd now be trading at $40 per share, still a total value of $8,000. Mathematically, nothing has changed about your total investment value.
So if the value is the same, why do companies bother doing it?
Good question. It's largely seen as psychological or a marketing move. A lower per share price might feel cheaper or more accessible to smaller investors who might be put off by a stock trading at, say, $500 a share. Bringing it down to $250 after a split might attract more buyers. In hot bull markets, stock prices sometimes even got a temporary boost after a split was announced, like a half-off sale perception.
Is there a practical reason sometimes?
Yes, if a stock price gets extremely high, the guide mentions Berkshire Hathaway, which famously resisted splitting for a long time and traded at tens, then hundreds of thousands of dollars per share splitting can make it more affordable for average investors to buy even a single share, improving trading liquidity, but fundamentally.
It's just accounting, doesn't change the company's real worth.
Exactly. It's like cutting a pizza into 16 slices instead of 8. You have more slices, but the total amount of pizza is exactly the same. It doesn't change the underlying value or prospects of the company one bit.
All right, now for a strategy that seems to go against the grain for most people, shorting stocks. This is trying to make money when a stock price goes down.
That's right. It sounds counterintuitive, maybe even a bit un-American to some, betting against a company. But from a purely trading perspective, the goal is profit, regardless of whether the price is going up or down.
Yeah.
Short selling is a way to potentially profit from falling prices. It's considered a more sophisticated, advanced strategy, and it tends to work best in declining or bear market conditions, or if you have strong conviction that a specific stock is overvalued and likely to fall.
How does it actually work? How do you sell something you don't own?
Good question. You start by borrowing the shares from your brokerage firm. They usually lend shares held in other clients' margin accounts. Once you've borrowed the shares, you immediately sell them on the open market at the current, hopefully high price. Then you wait, hoping the price falls. If it does, you then go back into the market and buy the same number of shares back at the new lower price. Finally, you return those shares you bought back to your brokerage to close out the loan. The difference between the higher price you sold them for initially and the lower price you bought them back at is your gross profit, before considering commissions and any interest charged for borrowing the shares.
The guide had an example like shorting at $20 and covering at $18.
Right. If you shorted 100 shares at $22,000 proceeds and bought them back at $1,800 cost, your gross profit would be $2 per share, or $200. The guide also mentions there are specific rules around shorting. For instance, historically, there was the uptick rule, meaning you could only buy back the shares, cover your short, when the stock price ticked up slightly, intended to prevent short sellers from relentlessly driving a stock down. And you generally can't short stocks trading below $5 a share.
What's the biggest risk with shorting? It sounds like it could go wrong.
It can go very wrong. The main risk with shorting is that, unlike buying a stock where your maximum loss is 100% of your investment if the stock goes to zero, your potential loss when shorting is theoretically unlimited.
Unlimited how?
Because if you short a stock and instead of going down, it goes up and keeps going up, there's no ceiling on how high the price can climb. You still eventually have to buy those shares back to return them to the broker no matter how expensive they become. If you short it at $20 and it goes to $50, $100, or even higher, your losses keep mounting infinitely. It makes shorting an extremely risky strategy that requires careful risk management.
Okay, this is a good point to shift into how investors and traders actually try to figure out which stocks to buy or sell or short. The guide lays out two main schools of thought, two main types of analysis: fundamental analysis and technical analysis. Let's start with fundamental.
Right. Fundamental analysis is all about digging into the underlying business itself. The core idea is to determine the company's true intrinsic value. What is this business really worth based on its financial health, its earnings power, its assets, its management, its position in its industry, and its future prospects? You're essentially analyzing it as if you were considering buying the whole company, not just trading its stock price.
So what kind of information are fundamental analysts looking at?
They're looking deep. They examine the company's financial statements, the balance sheet, income statement, cash flow statement. They look at things like revenue growth, profit margins, earnings per share, debt levels, return on equity. They analyze the quality of the company's management team, its competitive advantages or lack thereof, the overall health and trends of the industry it operates in. The goal is to find companies whose stock price seems undervalued compared to this calculated intrinsic worth.
They use specific financial statements as their main tools then.
Yes, absolutely. The balance sheet is key. It's like a snapshot of the company's financial position at a single point in time, showing what it owns, assets, what it owes, liabilities, and the owner's stake, equity. The guide does caution, though, that balance sheets require skill to interpret properly. Companies can sometimes use accounting tricks to hide debt or make their assets look better than they are. It reinforces that idea of needing to understand the business. Then there's the income statement, sometimes called the P&L or profit and loss statement. This shows the company's financial performance over a period of time, like a quarter or a year. It details the company's revenues, sales, the top line, and subtracts all the costs and expenses to arrive at the net income or profit, the bottom line. Fundamental analysts want to see both revenues and profits growing consistently over time.
And earnings per share is derived from that?
Exactly. Earnings per share, EPS, is a really critical metric from the income statement. It's the company's total net income divided by the number of outstanding shares. It tells you how much profit the company generated for each share of stock. If a company isn't earning money or its earnings are declining, it's very hard for its stock price to go up sustainably in the long run. Analysts track EPS growth very closely, comparing it to past periods and analyst expectations.
What about stock ratios? Are those fundamental tools too?
Yes, ratios are hugely important tools for fundamental analysts. They take numbers from the financial statements and compare them to the stock price or to each other to get quick insights into valuation and performance. Probably the most famous one is the price-earnings ratio, PE.
We mentioned PE earlier. How is it calculated and used?
You calculate it simply by dividing the current stock price per share by the company's annual earnings per share, EPS. It essentially tells you how many dollars investors are currently willing to pay for each dollar of the company's earnings.
So a high PE means expensive, low means cheap.
Kind of, but it's relative. A high PE might mean the market has high expectations for future growth, while a low PE might suggest low expectations or that the company is undervalued. Value investors like Warren Buffett often look for stocks with low PE ratios, maybe below 15 or even 10. Growth investors might be comfortable paying a much higher PE, say 50 or more, if they believe the company's earnings are going to grow extremely rapidly to justify it. The guide stresses PE is just one tool, not a magic bullet. A low PE doesn't automatically mean buy, nor does a high PE mean avoid. It's most useful when comparing a company's PE to its own historical range, to its competitors in the same industry, or to the overall market's PE, like the S&P 500's average PE, which can give clues about overall market valuation.
The guide also mentioned the price-to-sales ratio. When is that used?
The price-to-sales PS ratio becomes useful, especially when a company doesn't have any earnings yet, so its PE ratio would be meaningless or negative. This is common for newer, fast-growing companies, maybe in tech or biotech. You calculate it by dividing the company's total market cap by its total annual sales revenue. An advantage, the guide notes, is that sales revenue is generally considered harder for companies to manipulate through accounting tricks than earnings are. It mentions the Enron case again, where its PS ratio was incredibly high, over 200, before it collapsed, way above typical high PS ratios, which might be over 5. Value investors often look for PS ratios under 1.
And return on equity, what does that measure?
Return on equity, ROE, is calculated by dividing the company's net income by its shareholders' equity, which is basically assets minus liabilities from the balance sheet. It's a measure of profitability that shows how effectively the company's management is using the money invested by shareholders to generate profits. Generally, a higher ROE, especially one that's rising over time and maybe above 15%, is seen as a sign of good management and a healthy, profitable business.
Fundamental analysis isn't just about numbers, right? The guide mentions talking to management and tracking insider activity.
That's right. More sophisticated fundamental analysts, particularly professionals managing large sums, might actually talk directly with company CEOs, CFOs, and other managers to get insights into their business strategy, competitive pressures, future plans, and general outlook. They also pay close attention to insider trading, both the legal kind and looking out for the illegal kind.
Legal insider trading is when executives buy or sell their own company's stock.
Correct. Corporate officers, directors, and anyone who owns more than 10% of a company's shares are considered insiders. When they buy or sell shares of their own company's stock, they are legally required to report those transactions publicly within a couple of days via filings with the SEC. While insiders might sell shares for many reasons unrelated to the company's prospects, like needing cash for a house, diversifying, significant insider buying is often interpreted as a bullish signal, a sign that the people who know the company best are confident about its future. This information is publicly available on financial websites and the SEC's EDGR database.
And illegal insider trading is using secret info.
Exactly. That's trading based on material, non-public information stuff the general investing public doesn't know yet, like knowing about a pending merger, a surprisingly bad earnings report before it's released, or a drug trial failure. The guide notes that while the SEC prosecutes some high-profile cases, it's widely suspected that a lot more illegal insider trading goes on under the radar. It mentions the Enron and WorldCom executives who sold large amounts of their stock before the company's troubles became public knowledge. It contributes to that feeling that maybe the game isn't always perfectly fair.
Finally, for fundamental analysts, there's the company's annual report. Sounds like homework.
It can feel like it. An annual report is a long, comprehensive document that public companies are required to publish each year. It contains the official audited financial statements, balance sheet, income statement, cash flow statement, a letter from the CEO discussing the year's performance and outlook, a detailed section called Management's Discussion and Analysis, MD&A, and lots of footnotes.
Is it worth reading?
The guide says yes, especially for long-term investors. While parts of it can be dense, and the CEO letter often has a positive marketing spin, the MD&A and especially the footnotes can contain crucial details about risks, accounting methods, legal issues, debt obligations, or potential problems that aren't always obvious from the main numbers. It's where the company legally has to disclose the nitty-gritty. Understanding the annual report is really key to deeply understanding the business you're investing in.
Okay, that's a solid overview of fundamental analysis, focusing on the business behind the stock. Now let's switch gears completely to the other main approach, technical analysis. How is that different? Technical analysis takes a totally different perspective. It's not really concerned with the company's intrinsic value, its earnings, or its management. Instead, technical analysis focuses purely on studying the historical price movements and trading volume of the stock itself. The core idea is that all known information, fundamentals, news, and market sentiment are already reflected in the stock's price action. Technical analysts look for patterns, trends, and signals in charts to try and predict where the price is likely to go next. It's much more commonly used by shorter-term traders.
So their main tool is the stock chart. Charts are absolutely central. Technical analysts spend hours looking at charts showing a stock's price history over different time frames, minutes, days, weeks, years. They're looking for trends. Is the price generally moving higher over time? That's an uptrend, often visualized by drawing a line connecting the rising low points. Is it generally moving lower? That's a downtrend, marked by connecting the falling high points. Or is the price just moving sideways in a range? That's a sideways trend or consolidation phase. They also look at volume during these trends. High volume on an up move is seen as bullish confirmation, while high volume on a down move is bearish.
And they talk about support and resistance levels on these charts.
Yes, support and resistance are key concepts. A support level is a price point where the stock has historically found buying interest and stopped falling. It acts like a floor. Buyers step in around that level. A resistance level is a price point where the stock has historically run into selling pressure and stopped rising. It acts like a ceiling. Sellers tend to emerge around that level. These levels are important because when a stock breaks decisively below a support level, it's often seen as a bearish sign that it could fall further. Conversely, breaking above a resistance level is often seen as bullish, suggesting it could rise higher. Sometimes stocks test these levels multiple times, forming patterns like double or triple bottoms at support or double or triple tops at resistance.
Are there other specific chart patterns they look for besides just support and resistance?
Oh yes, technical analysis is full of named chart patterns that analysts believe have predictive value based on how they've played out historically. The guide mentions a few classic examples. The head and shoulders pattern, usually a bearish signal suggesting a top is forming. Double tops and triple tops, also bearish reversal patterns. And conversely, double bottoms and triple bottoms, often seen as bullish reversal patterns indicating a potential bottom. The guide specifically notes that knowledgeable technical analysts identified bearish patterns like head and shoulders and double tops forming on the NASDAQ index charts before the big tech crash in 2000, seeing warning signs in the price action itself.
And volume plays a role in confirming these patterns too.
Absolutely. Volume, again, the number of shares traded is considered a crucial confirmation tool for technical analysts. A breakout above resistance on high volume is seen as much more convincing than one on low volume. Similarly, a breakdown below support on high volume is more bearish. Volume helps gauge the strength and conviction behind a price move or pattern.
Lastly, they use things called indicators or oscillators. What are those?
Indicators and oscillators are essentially mathematical calculations based on a stock's price and/or volume data. They are plotted on the chart, often below the main price chart, and are designed to generate potential buy or sell signals or provide insights into momentum, trend strength, or overbought, oversold conditions. The guide mentions a couple of well-known examples like the RSI, Relative Strength Index, and MACD, Moving Average Convergence Divergence, though it doesn't detail how they work. These tools can signal if a stock's price has perhaps risen too far too fast and might be due for a pullback, overbought, or if it has fallen sharply and might be due for a bounce, oversold. However, the guide wisely cautions that indicators can generate false signals, especially in choppy markets, and are best used in conjunction with other forms of analysis like chart patterns and trends, not relied upon in isolation.
The guide suggests that some traders actually try to use both fundamental and technical analysis. It's not always one or the other.
That's definitely true. Some investors might use fundamental analysis to identify what stocks to buy, finding companies they believe are solid, well-run businesses trading at a reasonable price. Then they might use technical analysis tools to help them decide when to buy or sell, looking for optimal entry points when the stock is showing technical strength or finding good exit points when the trend appears to be weakening. The idea is that the more tools and perspectives you understand, the better equipped you might be to navigate the market.
Okay, moving beyond the company itself and its chart, what about external forces, big picture stuff? What influences the market from the outside?
Yeah, the market definitely doesn't exist in a vacuum. It's hugely influenced by macroeconomic factors and major world events. Political uncertainty, wars, recessions, pandemics, terrorism. All these things can ripple through the market, causing widespread buying or selling. But perhaps the single most powerful external influence, particularly on the U.S. market, comes from the Federal Reserve System, or the Fed.
The Fed, we hear about them all the time. What gives them so much clout over stocks?
Well, the Fed has several core jobs: keeping the U.S. economy stable, managing inflation, keeping prices from rising too fast, and deflation, preventing prices from falling broadly, and controlling the nation's money supply. Their most direct and powerful tool for doing this is their ability to influence interest rates. They primarily do this by buying and selling U.S. Treasury securities in the open market, which affects the amount of reserves banks have and consequently the interest rates banks charge each other and ultimately charge businesses and consumers for loans.
And how does fiddling with interest rates affect the stock market?
It has a huge impact. When the Fed lowers interest rates, it makes borrowing money cheaper. This tends to encourage businesses to invest and expand and consumers to spend more, like buying houses or cars, which generally stimulates economic activity. Stronger economic activity often leads to higher corporate profits, which is usually good for stock prices. The guide notes how periods of low rates fueled things like the housing boom and waves of mortgage refinancing.
And raising rates.
Raising rates has the opposite effect. It makes borrowing more expensive, which tends to slow down business investment and consumer spending, potentially cooling off the economy to fight inflation. This can be a headwind for corporate profits and often puts downward pressure on stock prices.
And the market hangs on the Fed's every word.
Pretty much. The market reacts very sensitively, often dramatically, to Fed announcements about interest rate changes, or even just hints or changes in tone about future policy. You often see big market rallies on news of unexpected rate cuts and sharp sell-offs on news of rate hikes or hawkish comments. There's that old saying on Wall Street, "Don't fight the Fed." The guide also throws in that it's kind of an open secret that the Fed, despite claiming independence, does pay attention to how the stock market is doing when making its decisions. So, yeah, you got to pay attention to the Fed.
What about the value of the U.S. dollar itself? Does that matter?
Yes, the strength or weakness of the U.S. dollar relative to other major world currencies definitely has an impact. When the dollar is strong, it makes U.S. assets like Treasury bonds and stocks seem cheaper and more attractive to foreign investors. They can buy more dollars with their currency, which can boost demand and be good for the market. However, a strong dollar also makes U.S. goods more expensive for foreigners to buy, potentially hurting U.S. export companies and tourism.
And a weak dollar.
When the dollar is weak or falling, it can sometimes make foreign investors nervous and prompt them to pull money out of U.S. markets, which can be negative. It also makes imports more expensive for U.S. consumers and travel abroad pricier. But on the plus side, a weaker dollar makes U.S. exports cheaper for foreign buyers, which can be a boost for U.S. manufacturers. So it's a mixed bag, but a rapidly falling dollar can certainly spook foreign investors.
Inflation and deflation came up again here as external factors.
Right. Inflation, as we discussed, is the gradual rise in the prices of goods and services, eroding the purchasing power of money. Investors often turn to the stock market hoping to earn returns that outpace inflation over the long term, as historical stock market returns, that debated 11% figure, have generally beaten inflation. Persistently rising inflation, though, can be a negative signal, potentially prompting investors to shift towards assets thought to hold value better in inflationary times, maybe certain commodities or safer havens like short-term treasuries or money market funds mentioned in the guide. Deflation, on the other hand, is the opposite, a general decline in prices. It's much rarer in modern U.S. history, but can be very damaging. It's often associated with economic contraction, high unemployment, falling asset values like real estate. While falling prices might sound good initially, it can lead to consumers delaying purchases, waiting for prices to fall further, businesses cutting production and jobs, and a really rough period for the stock market. The guide calls it an unusual nightmare.
And other government reports, like jobs reports or GDP.
Yes, the market watches those closely too. The monthly unemployment report gives a key reading on the health of the labor market. The GDP, Gross Domestic Product report, released quarterly, measures the overall output of the U.S. economy. It's the broadest measure of economic health. Strong GDP growth is good. 2 consecutive quarters of negative GDP signals a recession. Generally, the market likes to see signs of steady economic growth, low unemployment, and low inflation. The Goldilocks scenario, not too hot, not too cold. But reactions can sometimes be counterintuitive based on what the market expects versus the actual numbers.
But ultimately, despite all these complex external factors, the guide brings it back to basics.
It does. It stresses that when you boil it all down, the day-to-day, minute-to-minute movement of any stock price or the market overall comes down to the simple law of supply and demand. Are there more people wanting to buy at the current price than sell? The price will likely go up. Are there more sellers than buyers? the price will likely go down. All the news, reports, and analysis ultimately feed into that basic equation. Expert explanations for why the market moved on any given day might sound smart, but often miss that simple core principle.
Let's delve into something maybe less tangible but equally important: market psychology. And related to that, scams and things to watch out for.
Yeah, the stock market is definitely a powerful psychological arena. It tests your character, your emotions. You feel elation when things go up, fear or even panic when they go down. The guide emphasizes that successful investing often requires emotional discipline learning to handle gains and losses calmly, sticking to your plan even when your gut is screaming at you to do something else. It forces you to develop willpower, which, as the guide says, is often the hardest part.
And there's the danger of just following the crowd.
Absolutely. Herd mentality. People naturally tend to follow what everyone else is doing, driven by either fear of missing out, FOMO when prices are soaring, or panic selling when prices are plunging because everyone else seems to be selling. This can lead to buying high and selling low, the exact opposite of what you want to do. Resisting the herd takes discipline and independent thinking.
What about actual scams? What should people be aware of?
One classic illegal scam highlighted is the pump and dump. This usually targets those risky penny stocks we talked about. Here's how it works. Scammers secretly accumulate shares of a cheap, thinly traded stock. Then, they aggressively spread false or misleadingly positive information about the company, maybe through spam emails, social media hype, fake news articles, chat room rumors, boiler room phone calls. The goal is to artificially create excitement and lure in unsuspecting investors, pumping up demand in the stock price.
And then they dump.
Exactly. Once the price has been inflated by all this manufactured hype and buying pressure, the original scammers quickly dump their shares, selling them at the artificially high price for a huge profit. This selling pressure, combined with the lack of any real substance behind the hype, causes the stock price to collapse, leaving all the investors who bought into the pump holding virtually worthless stock. The internet has unfortunately made spreading these rumors much easier.
And illegal insider trading, which we touched on, is another kind of scam on the public.
It really is. When people trade based on confidential material information that isn't available to the public, they gain an unfair illegal advantage. It undermines the integrity of the market. The guide reiterates that while the SEC tries to police it, it's likely more prevalent than we realize and contributes to the sense that the playing field isn't always level. Manipulation definitely happens.
This leads us perfectly into what might be one of the most valuable sections. Why do investors so often lose money? The guide lays out several common painful mistakes.
Yes, and these are lessons often learned the hard way, unfortunately, after the damage is done. The guide draws from experience, observation, and insights from top traders.
Okay, what's mistake number one? The big one.
Letting small losses turn into large ones. This is probably the single biggest killer of investment returns. It's the mistake of holding on to a losing stock for too long, refusing to admit you were wrong, just hoping and praying it will come back. Instead of cutting the loss when it's small and manageable, you let it grow into a huge, devastating loss. The guide mentions how people who got used to buying the dip in the 90s bull market kept doing it in the bear market, only to watch stocks fall 80%, 90% or more. By that point, it's basically game over for that investment.
So what's the rule, the discipline to avoid this?
The guide is adamant. Have an exit plan before you even buy the stock. Specifically, implement a stop-loss rule. The suggestion given is, if any investment falls more than, say, 10% below what you paid for it, some experts use 8%, you sell it. Period. No questions asked, no second guessing, no waiting to see if it bounces tomorrow.
Even if you still think the company is good.
Yes. The falling price itself is the market telling you something is wrong, maybe something you don't know about yet. The stop-loss rule isn't about predicting the future. It's about preserving your capital and preventing a small, acceptable loss from becoming a catastrophic one that wipes you out. You can use an actual stop-loss order with your broker, or just make it a hard and fast mental rule you force yourself to follow. Action is key.
Okay, mistake number two is kind of the flip side, but about winners. Letting winning stocks turn into losers.
This one is almost as painful psychologically. You buy a stock, it goes up nicely, you feel great, but you get greedy. You hold on, wanting even more gains. Then the stock starts to fall, and you watch all those paper profits evaporate, maybe even turning into a loss. You didn't have the discipline to lock in some of the gains when you had them.
Why do people do that? Fear of missing out on more upside? Taxes?
All of the above. Fear of selling too soon and missing further gains, reluctance to pay capital gains taxes on the profits, or just simple overconfidence, thinking the stock will go up forever.
and the corresponding rule for managing winners.
The guide suggests that when you have a significant gain on a stock, the high five effect, consider selling a portion of your position. Maybe sell 30% of your winning shares. This does two things. It locks in some real profit. You can't lose money you've already taken off the table, and it reduces your risk if the stock does pull back. Remember the saying, you can't go broke taking a profit.
The guide skips mistake 3, but mistake number 4 is betting all your money on one or two stocks, lack of diversification again.
Exactly. It comes back to putting too many eggs in one basket. Concentrating your entire investment portfolio into just one or two stocks is extremely risky. It's essentially gambling, not investing. Yes, you might hit the jackpot if that one stock soars, but if it crashes, you lose everything. The guide suggests a rule of thumb. No single stock position should represent more than, say, 10% of your total portfolio value. But achieving that level of diversification with individual stocks requires significant capital.
So what's the solution if you don't have, say, $100,000 to spread across 10 stocks?
For most people with more modest amounts to invest, the guide strongly recommends using mutual funds, especially diversified index funds. Buying one or two broad market index funds gives you instant diversification across hundreds or even thousands of stocks, achieving that risk reduction goal much more effectively and affordably than trying to pick individual stocks yourself. Hiring a qualified investment advisor is another option if you have sufficient assets.
Mistake number 5 sounds a bit philosophical. Unable to be both disciplined and flexible. How can you be both?
It seems contradictory, but it's crucial. Lack of discipline is cited as a major reason people lose money. Discipline means having a strategy, having rules, like stop losses, position sizing, and sticking to them, especially when your emotions, fear, greed, are telling you to abandon the plan. Knowing what to do is the easy part. Having the willpower and courage to actually do it when the pressure's on is the hard part. But at the same time, you need flexibility. You need to be able to recognize when your chosen strategy or rules simply aren't working in the current market environment, or when the market action in a specific stock is clearly telling you your initial thesis was wrong. You can't be so rigid that you refuse to adapt. It's a balance. Have conviction in your plan, but be humble enough to change course when the evidence dictates.
Mistake number 6. Don't learn from mistakes. Seems obvious, but hard to do.
Very hard. The guide makes the insightful point that you often learn far more from your losing investments than your winning ones. The problem during the long bull market of the 1990s was that many people made money easily without really knowing why, so they never learned the crucial lessons about risk management, discipline, or analysis. When the market turned down, they were lost. Losing money, while painful, can be the best teacher if you take the time afterward to honestly analyze what went wrong with your thinking or execution, and then adjust your approach accordingly. Review your trades, especially the losers.
Mistake number 7. Listening to or getting tips from the wrong people. This sounds common.
Oh, classic mistake.
Yeah.
Everyone loves a hot stock tip, right? It promises easy money without doing the hard work of research and analysis. But tips are rarely reliable and often come from sources with ulterior motives. The guide specifically warns against blindly trusting advice from people on Wall Street whose jobs depend on you constantly buying and selling. They have an inherent bias towards optimism. It'll come back. And rarely advise selling.
And be skeptical of analysts, too.
Yes. The guide highlights the potential conflict of interest with sell-side analysts, the ones working for the big brokerage firms. Their firms often have lucrative investment banking relationships with the very companies the analysts are supposed to be rating objectively. There can be immense pressure on analysts to maintain positive ratings, buy, hold, to keep that banking business happy. The guide mentions an example of an analyst who correctly downgraded a major stock facing criticism, only to be proven right later. The SEC has looked into this incestuous relationship, but the advice remains. Take analyst ratings and price targets with a large grain of salt. Understand their potential biases.
So bottom line, be wary of anyone whose interests might not align with yours. Brokers on commission, companies hyping their own stock, potentially biased analysts.
Precisely. Always ask, what's in it for them when you hear a recommendation?
Finally, skipping a few, mistake number 10. Mismanaging money or missing out on money. This sounds broader.
It is. It's about overall portfolio and risk management. The guide stresses a key principle, often attributed to top investors. Rule #1, don't lose money. Rule #2, don't forget rule #1. It sounds simple, but it's incredibly hard. It emphasizes that preserving your capital is paramount. It's not just about how much you make on your winners, but critically, how much you keep by avoiding large losses. This requires taking personal responsibility for every decision.
The guide mentions the $8 trillion lost in the bear market.
Yes, a stark reminder that easy gains made without understanding how they are made, like in the late 90s, can vanish just as quickly. You have to take ownership. The government or Wall Street isn't going to save you if you make bad choices. It's serious business.
To wrap things up, the guide concludes with some personal thoughts and insights from the author, speaking from an independent perspective.
Right. Since the author isn't tied to a big firm, they feel they can be more objective. A key point is that there's no single right answer or magic formula in the market. Everyone has to figure out what works for them and make their own informed decisions.
And an interesting point about maybe listening more to traders than long-term investors for market direction.
Yeah, that was thought-provoking. The idea is that short-term traders, who are often in and out quickly and might end the week in cash, tend to be more objective about the market's immediate trend. They don't care if it goes up or down, as long as they catch the move. Long-term investors, by nature, tend to be perpetually hopeful that the market will eventually go up, which might cloud their judgment about current conditions. Food for thought.
And challenging that widely quoted statistic about average market returns.
Yes, questioning the common 11% average annual return figure for the stock market. The point made is that market indexes like the S&P 500 are constantly evolving. They kick out companies that go bankrupt or perform terribly and replace them with successful, growing companies. This process of reconstitution inherently biases the index's historical return upward compared to what an investor would have achieved if they had simply bought and held the original basket of stocks over that same long period. It suggests the average return might be harder to achieve than the simple index number implies.
The market definitely tests your character, as mentioned before.
It really does. It exposes flaws in discipline, emotional control, and forces you to learn, often the hard way.
And a pretty strong take on fraud and manipulation.
Yeah, the author doesn't pull punches there, suggesting that beyond simple scams, there's outright fraudulent activity, sometimes padded sales, hidden options costs, manipulated ratings, and expressing the opinion that perhaps the biggest game is convincing the public the market is totally fair and equitable, when in reality, manipulation through rumors, hype, and maybe even coordinated action does occur.
So personal responsibility comes through as the absolute core message again.
Over and over. You are on your own. If you choose to participate, you have to treat it like a serious business, do your homework, manage your risk, be disciplined, and take ownership of your results, good or bad.
What's the author's final take on whether someone should try the market?
It's nuanced. You don't need a fortune to start. You can begin with a small amount, gain valuable experience, and learn important lessons as long as you are fully aware you could lose that initial stake. The author personally believes most people are probably better off sticking with diversified mutual funds rather than trying to pick individual stocks, which requires a lot more skill, time, and temperament. But, they concede, maybe you listening are different. Maybe you have the interest and discipline to succeed with individual stocks.
And finally, the guide teases this secret strategy the author claims works, particularly in retirement accounts.
Yes, they mention a specific strategy called time zone trading, which they say they know works, especially within tax advantage plans like 401ks or 403bs, and that few people are aware of it. They mention another author, Gary Smith, wrote about similar timing ideas, but maybe not this exact application.
Okay, intrigued. What's the basic concept behind this time zone trading?
It's based on the observation, or theory, that foreign stock markets, like those in Europe and Asia, tend to follow the direction of the U.S. stock market from the previous day, a significant portion of the time, maybe 2/3 of the time or more.
So how would you actually use that information in, say, your 401k?
The strategy described involves closely watching the U.S. market near the end of its trading day, say the last 15-30 minutes. If the U.S. market indexes, like the S&P 500 or Dow, are up significantly, the example uses maybe 1% or more, you would then make a transfer within your 401k account. You'd move money out of a safe haven, like a money market fund, and into an international stock mutual fund offered within your plan.
Why? What's hope?
The hope is that when the European and Asian markets open hours later, they will follow the positive lead from the U.S. market's close, causing the international fund you just bought to gain value overnight, our time. Then, the next day, before the U.S. market closes, you transfer the money back out of the international fund and into the money market fund, aiming to lock in that small overnight gain.
So you're basically trying to capture positive momentum carrying over from the U.S. close to the international open, and you're mostly in cash otherwise.
That's the idea. You're trying to time these short-term moves. The guide suggests making the decision late in the U.S. day, and if unsure, maybe don't move, or only move half your intended amount. The appeal is being in the safety of cash most of the time, only entering the international market briefly when you perceive a high probability of an overnight gain based on strong U.S. momentum, thus hopefully avoiding bad days and participating in some good days overseas.
The guide mentioned that even small gains, like 1% a week, could add up significantly.
Yeah, the math is compelling. 1% a week is 52% a year if you could actually do it consistently. Though the guide realistically notes maybe it's closer to 0.5% a week in a tougher market. But it clearly requires active monitoring and quick decisions near the market close.
Are there catches? Criticisms of the strategy.
Oh yes, several big ones. First, mutual fund companies generally dislike frequent traders or market timers. They might impose penalties or restrictions, especially in regular taxable brokerage accounts, though the guide suggests many 401k plans might currently allow it without penalty, but that could change. Second, many market experts argue convincingly that market timing is extremely difficult, perhaps impossible, to do successfully and consistently over the long term. Third, strategies like this, if they work, tend to stop working once they become widely known and practiced.
And presumably you could still lose money.
Absolutely. There's no guarantee the international markets will follow the U.S. lead. You could make the switch, and the foreign markets could fall overnight, resulting in a loss, maybe 0.5% or 1% in a day, even in a fund. The guide explicitly states this is not a strategy for beginners and requires significant attention and discipline.
Wow, okay. What a truly deep dive that was into the world of stocks. We really covered the waterfront from the absolute basics of what a share even is, that piece of ownership,
To the nuts and bolts of how exchanges work, the different players involved, investors, traders, institutions.
the different ways people try to analyze stocks, fundamental versus technical, and all those external forces, the Fed, the economy, pushing things around.
And maybe most crucially, hitting on those common, often painful mistakes investors tend to make, and hammering home the importance of things like discipline, diversification, managing risk, and frankly, being skeptical.
Yeah, hopefully unpacking all of that gives you listening a much clearer picture, maybe some aha moments. The goal was really to help you feel better equipped, more confident the next time you hear about stock prices moving or get some market news. Understanding the why behind it all, supply and demand, price versus value, those Fed actions seem so vital.
It really is. And remembering that risk is always part of the equation, whether you invest or not. The key is understanding those risks and using smart strategies like diversification and having that stop-loss plan to manage them according to your own situation.
So as you think back on everything we've covered in this deep dive, maybe consider this. Given the inherent ups and downs of individual stocks, the real difficulty in consistently picking winners, and those undeniable psychological traps and potential for manipulation we discussed, how does understanding all this maybe shift your perspective on what a truly wise or responsible investment strategy might look like for you? Even if that strategy ends up being something as straightforward as regularly contributing to a diversified mutual fund.
Or maybe boil it down even more simply. When you're inevitably faced with that next exciting stock tip from a neighbor or read a breathless market headline, what's the single most important principle or lesson you'll take away from this deep dive to keep yourself grounded and guide your thinking?